Good evening, everybody. Welcome to B&H University, and we're excited to have you here this evening for what will prove to be what is already proving to be an energetic, interesting conversation with Tim. Um, I'm Cliff Hockley. I'm the president of Bluestone Hockley Real Estate Services and executive director of SVN, Sperry Van Ness, Bluestone Hockley, and two sister companies. And we're going to be talking about economic patterns and inflation, and we know inflation is here because the wages are just going bonkers because it's hard to find people to work. There's a lot of reasons for that. I think that Tim is going to talk about that a little bit. Please send your questions during the presentation via chat box. That would be helpful. We'll try to answer them all at the end of the presentation. We expect Tim's presentation to be about 45 minutes, and then we'll have 15-20 minutes of Q's and A's afterwards. We're very excited to be co-sponsoring this event with Lewis and Clark and University of Oregon. And that brings me to the next slide on the presentation. For those of you that don't know, SVN is the sister company of Bluestone Hockley Real Estate Services, and SVN is involved in real estate transactions in the multifamily, retail, office, and industrial hospitality in Oregon and Washington. We tend to represent owners and tenants of mid-range buildings in the 500,000 to 20 million range. That's sort of the brokerage side of the business. On the management side, Bluestone Hockley Real Estate Services is a leading full-service property management company managing over $2 billion in assets, which includes 7,000 condominium units, including McCormick Pier, which is this beautiful picture that you see here at the waterfront, 1,700 residential units, 2 million square feet of commercial property. And of course, we're dedicated to maximizing returns and protecting real estate investments for our clients. Let's move onwards. And so without much further ado, I'm introducing Krista Hiles, who's co-sponsoring with us this evening. Krista, you're on.
Thank you, Cliff. We're excited to be part of the presentation. Just to introduce Lewis and Clark Bank, we're a small local community bank here in the Pacific Northwest. We have presence in the Tri-County area in Portland, Southwest Washington, as well as in Clatsop County on the coast with Seaside and Astoria. We've been around since 2006, and we have a variety of traditional banking services, but we're primarily focused on real estate lending to business owners and real estate investors. We have an experienced lending team that has, like I said, a geographic footprint of the Pacific Northwest, mostly Oregon and Southwest Washington. And our target market is for commercial real estate, business, typical business loans and lines of credit, multifamily term loans, as well as some SBA loans. And our target loan size is typically ranging from $500,000 to $5 million. But as a locally owned bank, we have flexibility to meet your clients' and or prospective clients' needs. And our average annual loan output each year is about $50 million. In addition to lending, we offer a full suite of cash management services, including the typical account management, as well as cash flow processing, money movement, and fraud protection services. And one of the founding characteristics of our Lewis and Clark Bank is that we have an entrepreneurial spirit. We want to partner with our clients to help your businesses grow, and we pride ourselves in being an expert even beyond traditional rates and products. And as always, we want to thank Bluestone & Hockley for co-sponsoring with us, and we look forward to today's presentation.
Thank you very much, Krista. Before I introduce Tim Dye, Professor of Economics at the University of Oregon, I want to remind everybody that we'll have a much better presentation if all of you push your mute button and we don't end up with the background noises like the dogs and the cats and the dishes and all that other stuff. So if I could ask you to please all push your mute button, and then I will introduce Tim, and we're off to the races. So thank you. Tim Dye received his BA in economics in 1991 from the University of Puget Sound and his master's and PhD in economics in 1998 from the University of Oregon. He is an extraordinary economist. You will find what will be a great presentation. Very fluid thinker. He is a prominent commentator on the Federal Reserve and serves as chief U.S. economist for SGH Macro Advisors. And he asked me to keep it short. So in the keeping it short, Tim, I'm turning it over to you for what should be a wonderful presentation on inflation and its real estate impact. Thank you very much.
Great, thank you for that, Cliff. I want to get started here because I know we've only got a certain amount of time to kick this off, so I'm gonna just go right into it. I've been calling this presentation "Struggling Against Supply Side Constraints." What are our challenges in the post-pandemic economy? And I think one of the key factors to keep in mind is that this recession was very short. The one we see here was only 2 months, 2 quarters. It was in many ways like a snowstorm, just a really big snowstorm where everything shut down at once. And then a couple months later, we reopened the economy. And then once we were able to start reopening the economy, output grew actually quite quickly. And the recession was not a very lengthy event, even if it was a very deep event in relative to recent history. So the economy really rebounded pretty quickly. And we saw this show up in a couple different places that's going to be relevant to our story today. I think one of the places we really care about is personal spending, so household spending. And what we see in this picture is what I call nominal spending. It's just the billions of dollars that are spent every year by consumers. And the black line here is the trend, basically the pre-pandemic trend. And I extended that trend out. And what you see is that now spending is actually already above that trend. And that's really, I think, where the source of our inflationary pressures are going to come from going forward, is the fact that somehow we've really spent more than we would have been without the pandemic. And we'll have to tell a story on why that's happening. Where you see the inflation is that if I adjust these numbers for inflation, we're actually a little bit below trend. Right? So somewhere in the system, we're getting a lot of price pressures, and those price pressures are really eating away at the nominal gains that we're making, and making real gains, real spending gains, a little bit less. But still, they're not really that far from pre-pandemic trends. The economy, as far as spending is concerned, has really bounced back pretty aggressively from the pandemic. And I don't think that this is actually, terribly well understood on a lot of dimensions, just how rapid spending growth has been. There is underneath the surface too, and part of this story as well, really a shift in the goods that we're spending on. Typically, or during the last recession, we spent less on goods spending and more on services spending. So really the hit was to goods spending, when goods spending dropped from 34 to 32% of total spending. Right? That essentially reversed itself in this recession. Right? Where suddenly we are forced to spend more on goods and less on services. Part of that has contributed to the inflationary pressures. We know that there's been more spending on goods than our system could really handle. It wasn't designed to handle that much good spending all at once, and therefore that created some inflationary pressures. But still, even if we restructure the economy back towards services spending, we're already spending more in aggregate on a nominal basis than we were prior to the pandemic. And that's where the constraints are going to come into bite. That's really what we're going to be focusing on today. So why are households able to spend so much? Going into the pandemic, I think there was this persistent fear that household spending was going to collapse, much as it did during the after the housing bust. And that didn't happen. It didn't happen for a number of reasons. One of which is that household wealth actually rose during the pandemic. One of the reasons household wealth rose was because of transfers from the rest of the world, or excuse me, from the federal government. We'll see that in a second. Another reason was that stock prices went up. And another reason was that housing prices went up. And another reason was that people for a period of time just weren't spending as much as they were earning. And so their savings were building up as a result of that. So there were a lot of factors that actually improved household balance sheets during this period of time and maintained strong spending power. Right? One of those factors was clearly this massive government stimulus. This is current personal transfer payments as a percentage of the overall economy. So this is transfers directly from the government to households. And what you can see is basically prior stimulus efforts, right? If you look at this last recession, for example, we're in no league, no comparison to the stimulus we had in this last recession during the pandemic. And that is, I think, a big part of why there's so much cash flowing around in the system right now. Right? Certainly this shows up in checkable deposits. So when you say that banks have a lot of money, one of the reasons is we've gone from checkable deposits on the order of $2 trillion to almost $5 trillion. Right? This is money that's piled up in the system as a result of the period of stimulus and the period of underspending relative to incomes. So households have been in great shape financially. And they've also been in great shape because wages in the labor market recovered quite dramatically. So this is wage and salary disbursements. And this is basically the key support of spending in the economy. And if you look at the 2007-2008 recession, once spending collapsed, it did not bounce back very quickly. Right? Whereas in this particular cycle, spending collapsed, wages and salaries collapsed, and then really bounced back to pre-pandemic trend very quickly. So this is a very different rebound, very different cycle than what we saw in the last cycle. And I'm going to argue there's a couple of reasons for this, and it's not just about the government stimulus. It's about the fundamental improvement of households' balance sheets in that part during this pandemic, as a result of the partially as a result of the government stimulus, but also I think it really has a lot to do with the fact that wage growth has been very aggressive. So household balance sheets have strengthened. Wage and salary disbursements have really left back to pre-pandemic levels, but we're still missing roughly 5 million jobs relative to prior to the pandemic. Right? That's a huge number of workers that just are missing, employees that are missing right now. And yet still we have ridiculously strong wage growth. It's really bounced back fully. And that's a big part of the story. Again, we've got to be able to talk about, if we want to talk about why we think these inflation dynamics might continue and what we should be watching for. There's another story here that's, I think, important for real estate, and I think has been a missing part of the story as to why this period of time we did not have a strong rebound in spending. We did not have a strong rebound in the economy or in jobs. We did not have a strong rebound in wages and salaries. And it's this demographic story. This is population by age. So this is the number of people in each age group in the US. And what I want to point out is that we're starting to climb this hill, right? And this is the hill of people that are entering into their 40s. So this is your elder millennial generation that's now going to be entering into their 40s, right? This group, once you start to get into 40s, is when your prime earning and prime spending years happen, right? So going forward, every year, really, we have a bigger and bigger cohort of people for basically the next decade moving in. This bulge here is going to move through the system. That's compared to what happened over the last decade, where we had this what I call the demographic hole of the Gen Xers, where essentially, because once the baby boomers started to phase out, they're being replaced by a smaller demographic group in that key age group. Right? Now we've got the opposite dynamic. I don't think people have completely appreciated the importance of this demographic hole. It's explaining really why growth was weak, why housing was weak in the last decade, and really one of the reasons why housing has been stronger in this last decade is that these are the millennials moving into their prime earning years and they're basically home buying years. right? That's a huge force that wasn't here over the last decade. And that's an important force propelling activity. I try to find a comparison. The closest comparison I can find is during the 1990s when the boomers really, and this is the 47 group, and the 47 group hit 40 about 1990, right? And so that was that big group that suddenly hit in the 1990s, and we climbed a huge hill then, and climbing that demographic hill helped really propel spending in the 1990s. And we've been really on the downside of that hill for much of the particularly the last decade before the pandemic. So we have a situation right now where we have fairly strong growth. We have households in great shape financially. We have had strong wage growth that's helped support spending. We have households with plenty of cash. We have households with low levels of debt. We have what we're going to see later, basically record low real interest rates adjusted for inflation. So we have really all the ingredients for a strong demand-led recovery. Now we've had this demand-led recovery, and it's run up against a problem of supply chain disruptions. And so this is a picture of the port of LA, and all these little lights are all the ships that are sitting off the port of LA trying to get into dock. This is the end result, not necessarily of the disruptions to the supply chain itself. That's a little bit part of it, but mostly because of the strong demand for goods and services in the US, particularly goods, that's really trying to be satisfied through the external sector, through the rest of the world. And we're seeing these huge supply chains emerge. And those supply chains are having some pretty clear impacts right now on the US economy. So what those clear impacts are, for example, this is motor vehicle production. And you can see it's dropped off relative to just 6-7 months ago. And this is a result of a shortage of computer chips in the global economy right now. And this has had a really remarkable sales of cars have dropped in a way that you typically only see during a recession. This is probably almost for sure going to drag down third quarter growth numbers. Now, this, though, isn't the result of demand being weak. This is the result of supply being weak, right? There's huge amounts of demand for vehicles. We just can't get the cars to the consumer, right? That's a classic supply side shock. And as a result of that, we've seen new and used car prices rise, right? And actually, this now has continued to rise too. So we've had a strong demand run into the supply side constraint, and that supply side constraint has really kicked off some of this inflationary process that we're starting to see right now. Another example has been in housing, where housing sales, new family housing sales, really jumped during the pandemic. Part of this was really part of the upward trend, right? This is the steady flow of improvement, and that's a steady flow of improvement that I would have expected to see as that millennial generation continued to age, and it's likely to continue going forward. But why did it come down? And a big reason that single-family homes have come down is because builders started throttling sales. They couldn't keep up with this level of sales, and that's because the supply chains were built around this trend, right? This trend was a supply chain. You can't supply more housing than that in the short run. And so sales had to come back down to meet that. Now, during that period of time, though, if you constrain sales, you constrain the supply of housing, at the same time you have huge demand, you see prices going up. And so you've seen explosive prices in housing. If you look at year-over-year housing growth prices, that's been faster than we saw during the peak of the housing bubble. What's amazing is what I see now is much more sustainable. This is not built on the kinds of lending that we had during the housing bubble. This is built on incomes and low interest rates, right? Straight up. This is not built on exotic mortgage products. That means that it's probably much stickier. It's much more likely to persist, in my opinion, going forward. So we've had, as a result of these supply constraints, as a result of this good economy and the supply constraints, a little jump of inflation, right? Now, that's the big question is it little or not? and is it sustainable, and will it grow on itself over time? Right? So we have this long period in the US economy of fairly low and stable inflation, right? Basically from the mid 1990s till now, like a 25-year trend essentially of low inflation. And that's a huge trend. That's sticky. Where we sort of we entered an environment where we really didn't think of inflation. It wasn't something that we really considered much when we made our decisions. But now we're starting to wonder, should we be taking inflation into consideration as we make decisions going forward, now that inflation is on our radar, right? Now, as of yet, this is nothing like we saw in the 1970s. I don't know if any of you out there remember the 70s or the early 80s. We obviously had a very high period of long period of high inflation. Now, we didn't think we could get in the 70s and the 1960s. So you go back in the 60s, there was a period of very low and stable inflation, and suddenly in the late 60s, it started to kick up, right? And it wasn't known at the time that this was going to generate a very persistent inflationary environment. And the question that we're starting to ask ourselves, is this going to return to trend, inflation going to return to pre-pandemic trend, or did we sort of, I don't want to say break the economy, but change the economy in such a way that now inflation is more persistent? And then what's going to be the policy consequences of that? Okay? So one thing we know is that this is not just about pandemic related items anymore. So if I look at what the White House Council of Economic Advisors has done, where they've separated out what they call pandemic affected services and then vehicle related issues. So what we're seeing in the auto market, for example, right now. And we look at what inflation is left over. Inflation here is still higher than what we had going into the pandemic. Right? So even if we take out the pandemic effects, even if we take out these vehicle effects, underlying the surface is some upward pressure on inflation. Right? And so that's significant. That tells us this is not necessarily temporary or transitory, as the Federal Reserve likes to say, but it's a little bit more persistent. Something else might be going on here. We can also look at these other measures, such as this Dallas Fed trimmed mean measure, which takes out the outliers, essentially on the high and the upside. And what you see is that started to rise a little. Right? Now you might not think that's a big rise, you know, and it's gone from say 2% to 3% inflation. Right? Well, if everything's set on 2% inflation, a move to 3% inflation is important. And it's also a question of whether or not the Federal Reserve is going to respond to that move that we're going to be talking about. What conditions will drive that to create where they want to respond to these inflationary pressures. Right? One of the factors going forward, and this is particularly relevant, I think, for this group, is, and you might have opinions on this, and I'd love to hear it afterwards, is that according to the way we do these statistics, we're just now seeing rent, and we're seeing the impact of rising rent in the consumer price index, both in rent of primary residence and what we call owner's equivalent rent, or what you can rent your house for. This suggests that rents of primary residences are going up at about 4 or 5% a year. Right? Now, I'll have a lot of people say that that's too low. That really, we should be looking at something closer to 8 to 10% a year. So I'll be looking forward to your comments on that. That is a big deal. It's a big deal for a couple of reasons.
Tim, I think you got muted.
Yeah, Tim, I'm not able to unmute you.
Do you think you should log in and log back
There we
out?
go.
There we go.
Okay.
Perfect. Yep. There he is.
Sorry.
Perfect.
Sorry about that. I do not know what happened there. Okay. You can hear me again, right?
Yep. 10-4.
Okay. So this particular issue of inflation broadening out, I think is key as far as it goes to rent. So this is rent of primary residence. So this is like apartments. And then this is owner's equivalent rent, what they think you can rent your house out for essentially. And we've just started to see those come up. And those are going to be very persistent forms of inflation. I think will also resonate more for the general public. They don't buy a used car every day, but they do pay the rent every month. So I think what you're seeing is what I call the pieces coming together for an inflationary dynamic going forward. And so that gets us the question of, is inflation going to rise or fall from here? And what should we really be watching? And then what are the implications of this? And I can tell you to start with, one of the implications is going to be what happens to interest rates. So they're going to be rising. When are they going to be rising? How far are they going to rise? And that's obviously dependent upon what the Federal Reserve anticipates or interprets the inflation data to be. So if we look at the Federal Reserve's core inflation projection, right, this is probably the most important inflation number they're watching. They see at the last meeting, sorry about that. What they saw, hold on. Highlighter. Okay. What they saw was that core inflation was going to be rising at about 3.7% this year. That's already wrong. It's probably going to be closer to 4%, if not higher. What they anticipate, though, is that inflation is going to be falling. So they anticipate that inflation is transitory, that's going to fall to 2.3%, then 2.2%, then 2.1%. None of this would be particularly worrisome. We can still hear me, right?
Yes.
Yes.
Okay, good. Okay. I just saw a little
Yes,
signal.
we can all hear you.
Okay. So what are they watching for, right? What does this relate to us? Well, what they're really watching for is a couple of things. One is what they call inflation expectations. So do we start to believe that inflation is going to be higher? And then does that make us accept higher prices more? And more importantly, what does that mean for the wage dynamic? So one thing we're watching is this issue of inflation expectations. Are they rising? Well, yes, they are rising. Right? So I've got two measures here. One's from the New York Fed, and that's the blue, and another measures from the University of Michigan, and that's the green. Right? The University of Michigan is a long history, and what we see is it's kind of back up to where we were prior to the pandemic, and it's really back up to really where the Fed would like it to be. So the Fed's kind of thinking inflation expectations have firmed up a little bit, but we don't want them to go any higher. That's kind of the question one issue. Then they're worried about, well, what could drive inflation higher? And this is where the issue of wages and inflation become important. The real key, the real thing that we're watching for, and I'm watching for going forward, is does this economic environment that we're in create a situation where average wages start to rise very quickly? And so far, what we've seen is a lot of pressure on wages, particularly at the lower end of the spectrum, that is driving up wage growth. Wage growth recently has been on the order of 6%, 7% annually. And we see this in a lot of places. But one place that I particularly look at is obviously fast food. We know like restaurants and have been having to raise their wages quite aggressively. Anywhere with a distribution center. So you'll see Amazon or Target starting salaries at distribution warehouses, somewhere, some cases, some localities, $20, $21 an hour plus signing bonuses. So that's in a lot of communities starting to set a new, basically lower bound for wages. And that's putting upward pressure across the wage spectrum. So in some sense, what we already have is this shock to the system, the pandemic shock that created these inflationary pressures and also created this tight labor market. And they're starting potentially to feed together in an interactive way. And that interactive way is really the key going forward. Why are they feeding together interactively? Well, one reason is there's an enormous number of job openings right now. Job openings are higher than they were prior to the pandemic, and people recognize this. And so what we see are quit rates. The number of people quitting their jobs is at record highs. And one reason you quit your job is because you're chasing higher wages. One reason you have to chase higher wages is because inflation has gone up, right? So that's the start of a persistent kind of wage price dynamic, wage inflation dynamic that really could last going forward. Right? We see these high job openings in a lot of industries. This is accommodation and food services, but also retail trade, manufacturing as a big place where we're seeing huge demand for jobs. I was talking to somebody yesterday in manufacturing sector, and they're getting requests for workers that want $100,000 a year to drive a forklift, for example. They're just struggling to get labor in the door. So what this has done is create what looks like more of a pre-pandemic labor market. The blue line here is job openings, and the green line is the number of people that report they're unemployed. And you can see the number of job openings have climbed above the number of the level of unemployment, right? And the gap is actually bigger than we had going into the pandemic, right? Now, my hypothesis, or one story that I'm exploring, is that this pre-pandemic era was perfectly balanced. The U.S. economy was in something of perfect balance, that unemployment was low enough that we were spreading the benefits of low unemployment to more and more people. And that was great. And it was low enough that we were getting some wage growth, somewhere around 4% a year. But we were doing that in such a way that wasn't inflationary. So we still had fairly low inflation, 2%. It was almost the ideal environment where we could really get the benefits of the economy to a wider and wider group of people. Right? Now, my question is, did we kind of break that? Did we break that during the pandemic? Did we break it because labor supply went left? At the same time, we stoked up the economy with lots of fiscal stimulus. And also, the same time, we may have misjudged what was going on in the economy. We thought it was this big negative demand shock, but it was more like a supply shock, more like a snowstorm, where everything just shuts down temporarily. And once you start to open it back up, then things take off. What sets, wow, I don't want needles in the back of my head, right, is that this kind of dynamic we're seeing right now is typically something we see later in the business cycle, right? This, right, what we saw in 2018, 2019, was at the end. It was at the end of a record long cycle after the Federal Reserve had already been tightening monetary policy for basically since 2013, right? A long period of fairly slow monetary policy tightening had really, I think, left the economy in almost a perfect balance, right? That's not the situation now. Now the monetary policy is still very, very easy, and we have a lot of late cycle dynamics that I look at and I see in the economy. Right? One of the challenges here has been labor supply hasn't recovered as quickly as people expected. It's showing more of a typical pattern where it recovers fairly slowly. So this is prime age labor force participation rates, and we got optimistic during this initial rebound in the economy, where people dropped out of labor force, and then as soon as the economy reopened, a lot of people came back in. It's been pretty weak as far as getting those people back in as quickly as we would like. Also, the older population, 55 and older, left the labor force and they haven't returned yet. Now, it could be, again, that this is just a temporary issue, that eventually these workers will come back to the labor market and it's just taking some more time. It could be something more persistent, though, that these older workers essentially have the means to stay out of the labor market. So after the last recession, for example, this period of time, we know that stock markets collapsed and didn't recover quickly, and housing equity fell dramatically and didn't recover very quickly. So wealth was damaged dramatically during that period of time, right? Now we have the opposite situation. So what we could be seeing is older workers who retired stay out of the labor force simply because they have the means to stay out of the labor force. Another story that I like to point attention to is what we call the beverage curve. It's a relationship between unemployment and job openings. And typically what we see is this relationship where unemployment falls at the same time job openings are rising. And what we've seen is a big dislocation, right? A whole big shift in the beverage curve, so that this job openings rate here that we have now would be normally associated with an unemployment rate around, say, 3%, if we say kept with our old Phillips, our old beverage curve here. This is a kind of dynamic that you see in a market with lots of labor market frictions and basically mismatches or inability to match workers and jobs. Right? That's usually an environment where we think that wages are going to go up, that there's hard time getting matches to workers and jobs, and there's tight labor markets, and that puts more upward pressure on labor markets. Right? If we compare workers that are similar, that have been continuously employed, right? Here's another statistic that typically declines during a recession or after a recession, and you can see how weak it stayed in this last recession, right? It never declined in this recession meaningfully, and has already started to rebound quite strongly above pre-pandemic trends. Right? And again, this is all raising red flags in my mind that even though we have 5 million workers less than we did prior to the pandemic and unemployed, that we're seeing dynamics that are much, much more consistent with a pandemic, with a later cycle, right? Even though monetary policy is still easing, right? Another way I show this, and a final story I think I tell you before I start to wind this down. These are aggregate weekly payrolls. This is another measure of basically nominal compensation for employees. Right? Nominal compensation for employees is growing at about a 10% pace, right? 10 to 11% pace year over year. Right? That's a very rapid pace. That pace was about 5% prior to the pandemic. Right? So that pace of growth is typically correlated with the growth of spending. Right? So if I go back and when I started this story, I said, look, the growth of spending has already propelled spending in nominal terms above pre-pandemic levels. Right? In order to sort of maintain that pre-pandemic trend, right, just to revert to trend, we need payroll growth to really slow to 5%. Right now, again, we're growing 10, 11, 12%, depending on the month. And so the average you take, it's somewhere in there. Right? So what I like to, the way I think about this is, if aggregate spending, consumer spending is going up 11% a year, and we think we're going to get 2% inflation, that means we have to get 9% more real stuff, more goods and services. Right? That would be much faster than the 3% pace of spending that we had prior to the pandemic, roughly 2 to 3% pace of real spending. Right? Essentially, if we keep dumping money in the economy at this rate and we don't get enough goods provided for it, the difference has to come from inflation. Right? So this story gives me this concern. I look at the labor market and I say, this labor market is running hot. The problem is not the supply chains behind us. The problem is we've kicked off this inflationary process at the time when we've just ramped up the labor market to super hot rates. Super hot, basically really ramped up. That's a mixed metaphors. That's not really, that's sloppy writing there. We've really ramped up the labor market dramatically. And that says to me, look, we're going to have potentially an inflation problem if we don't start slowing down the economy, or the economy doesn't slow by itself. Right? So the Federal Reserve, though, has updated their policy framework, and their updated policy framework says they're not looking at the level of unemployment as a guide by itself. Right? They're basically saying we aren't going to say that the economy is operating at too high a level of employment. They made that mistake in the last recession, and now the last expansion, and they want to correct for that, right? They don't want to look at the labor market and say, oh, this is too hot. We need to put people out of work. Right? So that's one issue. And that's why they've resisted raising interest rates, even as unemployment has fallen to where they think it's going to be in the longer run. Right? So in the last recession, the last expansion, they started the process of tightening up monetary policy somewhere here, right? Somewhere near there, when unemployment was still high relative to the thought was sustainable in the longer run. The way they're going right now, they will just barely start tightening up policy as we get to that number, that sustainable number over time, right? So they're going to, and that's just sort of what we call tapering asset purchases. That's not even talking about raising interest rates. When those two lines cross to here is when the Fed started raising interest rates last cycle. Right? So the Fed isn't looking at the labor market in the same way as it used to. And also, the Fed had wanted inflation to rise. And they'd wanted inflation to rise somewhat above 2% because part of the new policy framework is to make up for past inflation shortfalls. That's actually already been achieved. The real thing holding the Federal Reserve back right now is they still think we need to add 5 million more workers to the labor force to get back up to those pre-pandemic levels. So they really want to keep the nominal economy heated up. Even as I get worried that we're just starting to hit the phase where overheating is really much more likely. So what I'm looking for going forward is really, does the labor market continue to do what it's done before, what it's done now, right? That's going to get us to the question of interest rates. And this tends to be very near and dear to real estate investors. Right now, interest rates are rock bottom levels. The Federal Reserve policy is holding interest rates near zero. Federal Reserve, these are what we call the dots. These are each participant in a Federal Reserve meeting gives their dot or their expectation of interest rates for next year, right? And about half the committee still thinks that at the end of 2022, right, that they're going to have zero interest rates. So from a year from now, half the committee thinks they're still going to have zero interest rates a year from now, right? Now, I talk to a lot of real estate investors in particular who will tell me that's just crazy, right? I can only tell you what the Federal Reserve is saying they're going to do. I think there's a lot of upside risk to this forecast, but that's what they're saying they're telling us they're going to do, right? Even after that, they don't see a very rapid rise in interest rates, right? By the end of 2024, the median interest rate is still below 2.25%, right? So what the Federal Reserve perceives right now is a very easy monetary policy. I'm going to show you some of the consequences of that, right? Well, actually, I'm going to show you a consequence of that first, then I'm going to step back for a second, right? These are real mortgage rates, right? So this is the 30-year mortgage rate minus inflation, right? So if I use what I call core, actual measured inflation, right, what we see is that real interest rates are negative. The first time we did that since the 1970s, right? This is highly unusual, right? Even though we've been on a downward trend of interest rates for a while, this is the first time we've gotten at really two negative levels on mortgage rates. What that means is if you think the interest rate is going to be 4 or 5% going forward, you certainly are borrowing money for free essentially right now, right? Once accounting for inflation. If I use those University of Michigan expectations I showed earlier, I still have the expectation that mortgage rates are zero right now. Right? That's a very stimulative environment. And I could do the same story for corporate debt. Corporate debt rates in real terms, adjusted for inflation, are also zero. We've seen stimulative environments before, like after the housing bubble, but this is sort of off. You have to go back to the 1970s, I think, to find an environment that's quite like this. This comes at the same time we've had this long downward trend of inflation, this long downward trend of lower interest rates. If that trend is still holding, then you actually don't get long-term interest rates up very much. Long-term interest rates right now, a 10-year, a 30-year rate, like around 2%, it does not rise more than 50 basis points unless you break this outsized trend. And I haven't seen any reason yet to tell me that this upside trend isn't going to break. So what I've got is the Federal Reserve that doesn't have a lot of room to raise interest rates, isn't eager to raise interest rates very quickly, and yet the economy is really racing forward. And I think what we're doing is taking too much of a backwards look and saying, oh, these things were this inflation was caused by these supply chain disruptions, and not enough forward-looking view. And I cannot give you a story where you can have 10, 12% nominal income growth and nominal spending power growth, and you're only going to get 2% inflation. In order to do that, you got to be making stuff 9%, 7%, 9% more a year of actual real goods and services. And that's just something that we haven't been able to do in this economy. So that's kind of the source of my anxiety. Sorry, I get these talks and I start starting and then I sound very, 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 very bearish. So what does this all mean? Right? What are my takeaways here? The expansion is probably self-sustaining. I don't see it as coming from fiscal stimulus at this point. I see it as coming from household spending power, right? Spending power, for example, that's driving up rents. And if you continue to drive up rents, what that does is drop down the price to rent ratio of housing. It makes housing more attractive and pushes back up prices there. That's the kind of dynamic we're thinking of. Also, I don't think we can ignore the fact that those millennials are moving up into their prime earning years, and it's a big, big group, right? That's going to be a huge source of demand, right? These constraints are biting, and they're creating these inflationary pressures, and I don't think they're going to get alleviated very quickly. Right? Even if they did, right? Even if you got auto production back up to where it should be, what you'd end up with is a situation where you had basically pent up demand, right? You'd still be falling behind. So it's not going to be very easy, I think, to get all of this out of the system, right? I'm more worried that it's not just temporary, that the economy was much more finely balanced prior to the pandemic than we realized. And as a result, the inflation is just going to be more persistent than we expected. And then we go from there and saying, is there going to be this wage inflation expectations dynamic that develops? That's what we're looking for, right? That's, to me, the key thing that I am watching for the next 3 to 6 months. Does the labor market continue to kick off nominal income growth at a rate of 10, 12%? That's just something that I don't think is sustainable without higher inflation. Right now, the Fed is not responding to this. The concern is that if they let this get out of hand, they're going to have to raise interest rates very quickly, right? And that sort of sets the stage for using the housing market to sort of balance the economy, which is kind of what we did in the 1970s. We had these frequent business cycles as a result. Now I don't want to get caught up in that just yet, right? The story that I'm telling is a dangerous story. It's a dangerous story because I'm saying we might have broken the economy in such a way that sticky inflation path that we had, that real nice setup that we had for 25 years prior to the pandemic, doesn't hold anymore. And so I've got to sort of look at that long period of time and say, that's a baseline. That's got to be expected, right? But I've got to look at that and say, where are all the risks to that baseline? And to me, all the risks are on the side of faster growth than anybody expects, faster nominal demand growth than anybody expects, and higher, more persistent inflationary pressures. Now, where that tends to benefit certain investors is places that are going to have rent that go up that you can keep an eye on, right? Or you can keep up in inflation or you can keep up with inflation, right? So traditionally, residential real estate has been a good inflationary hedge. One of the reasons is because inflation goes up, incomes go up, right? And because incomes go up, your affordability goes up, right? And that rise in incomes compensates for the higher interest rates you tend to get during an inflationary period. So it tends to be that residential real estate has done well. The other reason it does well is because in places where you can change the rent. Now, in Oregon, we haven't gotten because we hooked up rent. I think our rent laws are sufficient, our rent caps are sufficiently flexible that we won't have a huge problem with this. But you're certainly rapidly rising rent will force groups or make groups call for more stringent rent control. But I think that sort of space is a safer space. One thing, we could talk for hours on all the sort of details here. Well, I already have talked for an hour. If my sort of more optimistic demand outlook holds, that tends to be better than average for retail space. I don't know that I'm talking downtown space. We'll talk about that in a second. But retail space, distribution, that kind of model, warehouses, those should be holding steady or growing in this kind of environment. I didn't talk a lot about core office space. Downtown areas in general are struggling. What's really the issue there is the work from home phenomenon and how long that lasts. I don't think we'll be permanent work from home, but I think we'll be partial work from home going forward. And that will change downtown ecosystems. And that will change the way firms use space downtown. So, for example, I think you'll probably see clients that want smaller spaces because they're people are sharing desks because they're not there all the time. So you don't necessarily need the same square footage as you did prior to the pandemic. I guess I could kind of look at my own experience where I go into my office 2 to 3 days a week. And then work from home the rest of the time. And I don't have a long commute either, but it's just probably what's going to happen here going forward. I think there's some reason to think that you want to keep a high in inflation, because if you're in a space with a multi-year lease product, you're going to have to think about an inflation clause of some sort. This is it will depend on the product and what the demand for the product is, and whether there's other landlords that are doing the same thing. But if you start to think about this idea that you have to worry about inflation and you have to plan for it, that leads to the environment where people start to expect higher inflation. They expect people to ask them for these kinds of clauses. Interest rates are heading higher, but I don't know how quickly. The Fed's not in a rush to tighten policy. And right now, like I said, half the Fed believes that they're not going to tighten interest rates until 2023. I think that's going to change. But right now, even if that changes, they're thinking, maybe the end of 2022. So over a year away before you had upward pressure on interest rates. And even then, you're stuck in this long downward trend of interest rates. I don't know what breaks you out of that downward trend yet. I think I'm pretty sure of it. Maybe if you sort of let inflation go, and if you let inflation go to 4 or 5%, and the Fed stops enforcing their 2% mandate, their 2% goal, that's the kind of thing where I think that we'd have much more sustained higher interest rates. But right now, what we see is people think the Federal Reserve is going to raise interest rates. What they've done is raise short-term interest rates, but not so much at the longer end. So that's the takeaways I have for you now. And that's about 45 minutes or 50 minutes. So I better quiet up now and take some questions.
So thank you. That was really good. That was just amazing, Tim. Thank you so much for this wonderful summary of where you see our current economy, where it's at and where it's heading. I know we had a few questions. Abby, do you have some questions?
No, we only really had one from Richard Raymer. He had said, I would like to know specifically what components of the economy are causing there to be a concern about inflation. There has undoubtedly already been enormous inflation in the past 5 years in real estate, unbelievable growth in construction costs during that same time period, these costs representing the largest component of any person's life expenses. Wages have not grown in keeping with actual inflation. And if they are growing now, then that may be a value component for a healthy middle class. So what is the sudden new concern about inflation?
Lots of questions in there, lots of details. Okay, so the way we measure inflation, as far as what the Federal Reserve cares about, is end user inflation. So they're not so much worried about what's going on in the middle of the supply chain. They want to know how that's going to affect final prices. And the measures that they use then don't reflect the same kinds of prices that you see. So for example, housing prices. Obviously, we all know that construction costs are high, pad costs are high, and this gets passed on to the consumer. And so housing prices go up, right? Housing prices directly are not in the consumer price index or the personal consumption expenditures index. What the government does is break housing prices essentially into two parts, a service component and a investment component. And as far as calculating the cost of living, they focus on the service component. And so they focus on the increase in rents, right? So the increase in rents, or what they think you can rent your house out for, what we call owner's equivalent rent. Some people have called this a hot mess because it doesn't seem to reflect what many think of people as rising housing prices. But what the government's trying to do is figure out, well, what's the real cost of living, right? As opposed to what's the return on my investment, right? The Fed doesn't want to tackle that investment question. They want to think about the cost of living. The other problem we have with that is, I, like many of you, are in a fixed mortgage rate product, right? Price of my house goes up, interest rates go up, inflation goes up. It doesn't affect my spending, right? So the Fed's wary about, and the government's wary about using rising asset prices as a reason to say, everybody's worse off, because in fact, I'm better off if housing prices go up. So that gets us to the issue of really then what's sustaining those housing prices over time. I would say that we've had two factors. One has been rising nominal wages. Rising wages were actually rising, and I should always add this chart. In 2018, 2019, I think we were really making some real progress on wage growth. But then we didn't really get the 2019 data until 2020. In 2020, we had other issues to focus on. So I think there was strong income growth going into the pandemic, and certainly it's been strong income growth going out of it. And there's also the issue of lower mortgage rates. And there's a combination of higher interest, higher wages, higher salaries, and lower interest rates have supported housing prices. And we know this must be true because housing prices have continued to go up. In the last housing bubble, when we hit the point where housing prices couldn't go up anymore, the mortgage industry came up with creative products to let us get around that. We haven't done that this time. We've gotten the benefit of, I think what people are missing right now is that income growth is actually quite strong. And that's what's really propelling housing prices higher in this lower stage. Plus, it's again, the millennial generation aging into their home buying years and aging into their higher income earning years. That's a factor in here as well. So I think those are what's holding housing prices up and are likely to continue holding housing prices up. What sort of sets us in motion and going the other way? Rising interest rates to a certain extent, but again, if long-term rates aren't moving very quickly, or have already hit the highest for the cycle, then you won't get a huge rise in mortgage rates. What you'll have to do to slow housing price growth is slow income and slow the labor market. And that would probably come out of the Federal Reserve starting to tighten up the cost of credit in the economy. That could start to slow the process going forward. I wouldn't expect a huge drop in asset prices outside of a recession as far as housing, residential housing is concerned. Simply because I think that the prices right now are more sustainable than I think is widely believed. It seems like I have another issue. If I had to say what asset was the weirdest one that I'm just too old to understand, it was that crypto space. To me, that's a space that screams overvalued assets. But maybe I'm just an old man. I just can't get on top of that whole thing. I don't know if that answered. There's a lot in that question, so I hope I got to it.
Space.
Yeah, thank you. That was good. Does anybody else have any other questions that they want to throw in the chat or even ask? If you want to unmute now, we'll try to do it one at a time. Maybe like raise your hand. Let's see if there's under more. There's a raise your hand feature. Do you have one like that? I don't see it.
I
I don't see it.
Yeah, I don't see it. So if you can throw your
No.
questions in the chat, that's going to be just more effective instead of having people
Yeah.
talk over each other. Does anybody else have any questions? What a quiet crowd or something. I don't know what's going on. Nobody. Wow. Well, it was an extraordinarily thorough presentation, Tim. It was really, really thorough. It took the building blocks and built them up, and you gave us a very clear understanding of where the economy may be heading, and the actions the Fed could take in the near term and the longer term. The one question I had on your Fed chart, the dot chart, are
Yes.
those base interest rates or are those market interest rates? It was hard to tell what interest rate you were talking about on
That
those.
interest rate is the short-term, very short-term interest rate. So like overnight interest rates, essentially.
So that rate would
that's-
be marked up by a bank to
It would
lend it for
generally
real
be
estate.
something, the prime rate would be generally hooked up to the overnight rate is the way I would think about it. So,
So it would be like that plus prime would be like 4 or 5%. And so so the way I look at that chart then, that in 23 we could have interest rates of somewhere around 5 to 6%.
yeah,
I
2% higher than they are right now.
Mhm.
That's your
Okay.
kind of zone. The Fed's in no rush to do that. It's really a story about how people are anchored in their past expectations. There's kind of a wide belief within the economics community that the last expansion was mishandled, in the sense that we needed more monetary policy and more fiscal policy.
Mhm.
And we've corrected all those mistakes for this expansion, this recession, but it's not clear that this was the same kind of recession. If you're going to get an inflationary outcome, it's because everybody in the policy community decided that the last expansion or the last cycle was what all cycles look like going forward. And this cycle is just a very different cycle.
Right.
That's at its core. If you get an inflationary environment, it will be because of a policy error. And I would say it's more the Federal Reserve than the federal government. I mean, the Federal Reserve's job is to offset federal spending if necessary. So that's where I would put the policy error should it occur. You know, in 3 or 4 months, if you see, again, labor markets continue to race forward, wages continue to rise, again, that nominal wage growth rising at a rate of 10% annually, that's to me red flags.
Right, and you're a Fed watcher, so is the Fed, it's about to have some significant, maybe potential changes at the top.
Well,
How do
that's
you,
become
or
a
at the,
mess lately. There's a lot of positions that are Federal Reserve Chair Jay Powell, his term is up at the end of January. And so we need to either renominate him or nominate someone else for that spot. The position of Vice Chair of Supervision is currently open. There is one open spot. In February, the vice chair his term expires. So there is a potentially substantial leadership change going on at the Federal Reserve. And I would love to be able to tell you something about what's going to happen there. But the White House is dragging its heels in giving us any guidance on this or making any decisions. And we need to sort of think about these things because you need Senate confirmation for these spots. So I would love to be able to tell you what the next Fed is going to look like and how much they're going to stick to, what I think this Fed would do, which is eventually raise interest rates. But right now I'm kind of stuck in a situation where I'm flying a little bit blind and we cannot shake anything out of the White House. It is just tight on this topic. Reporters don't have anything. Nobody has anything. It's just dead.
okay. Well, thank you so very much, Tim. That was excellent. Amazing presentation. Thank you so very, very, very much. And
My pleasure.
have a wonderful evening, everybody. And if you have other questions, please don't hesitate to send them to us by email. If you have suggestions, we might want to do differently. But I think this presentation was probably one of the best I think we've had this year, and I'm very excited. Thank you so very much.
Very awesome.
All right. Have a great evening, everyone.
You too. Thank you.
Thank
Thank you for your
you.
preparation there.
Thank you.
Good night. No, almost. I am. Yes. Well, thank you, everybody, for joining us, and we'll see you all next time. Good night.